Hello, everybody, and welcome to our latest energy market update. We know already that gas prices drive electricity prices. And to put things in context, benchmark gas prices are up about 80% over the last 12 months. So let's look at some of the factors that are driving gas prices higher currently. One of the main factors is the situation around European gas storage. So in Europe, they pump gas underground in the summer, and then they take it out during the winter. So here are aggregated European gas storage levels. And what we can see is that storage levels for this time of year below where they were in 2023 and also below where they were in 2022. So in fact, the storage levels are below the 5-year average. That's because gas has been taken out of storage at the fastest pace in 7 years because of the cold start to the winter. And obviously there's continued potential for cold weather as we move through the winter and even into March and April. And that's worrying the market, and hence it is supporting prices. Another factor that is supporting prices, and it's related to the storage, is the current structure of the gas pricing curve. So if I show you some gas prices here, and what we're particularly interested in is the difference between summer 25 and winter 25 gas. So here's summer 25, where I'm hovering the mouse, and winter 25 below it. And currently, summer 25, if we look at the recent settlement prices, it is trading above winter 2025. And what that means is there's no incentive to buy summer 25, to pay for the cost of storage and inject the gas on the ground and then to sell it forward for winter 25. And what that is saying is the market sees severe concerns around sourcing gas for storage this summer, that things are going to be tight. Okay. Another factor that is supporting gas prices currently is the price of gas in the US. So Europe gets about 25% of its gas from the US in the form of liquefied natural gas. And US liquefied natural gas prices are dictated by the domestic price of gas. And as I'll show you here in this chart, those domestic US gas prices have pushed up through some key levels of late. These blue lines that I've drawn on the chart. In fact, they're up about 30% over the last month, and they'll probably continue rising. I would foresee a longer-term cyclical move higher in US gas prices, and that's feeding into European gas prices because of the close supply relationship. And that will continue to push European gas prices higher. So that's another factor that is increasing gas prices currently. And finally, there are several geopolitical factors that we could look at that are supporting gas prices, including what's happening in the Middle East. There's continued potential for new military action against Iran because it looks to be moving towards a nuclear weapon. Because of Iran's strategic location on the Persian Gulf and its impact on energy flows from the Persian Gulf, and that would most definitely put risk premium into energy prices. But we look at something else. We will look at something related to the Ukrainian war. Here's a map of a pipeline called Turk Stream. And Turk Stream is the last remaining Russian gas pipeline to Europe. You can see it crosses the Black Sea here. Where I'm moving the mouse here is Crimea. And Turk Stream carries about 4.5% of Europe's gas. So after the sabotage of the Nord Stream pipeline up in the Baltic and the end of the transit agreement with Russia across Ukraine itself, just there after Christmas, Turk Stream was the last remaining Russian pipeline to Europe. And apparently in recent days, there's been several drone attacks on the pipeline, particularly here just before it enters the Black Sea on some of the pumping stations. So if Ukraine manages to take out Turk Stream because they don't want Russia earning money from exporting gas to Europe, then Europe will lose another 4.5% of its gas, and it already lost 6% of its gas when the transit agreement with Ukraine ended there just after Christmas. So that's something we will be keeping an eye on as well. Okay, so they're all factors supporting the price. So if we look at the price chart, let's take the benchmark summer 25 gas contract as a market proxy. What you'll see from this chart is you can see how the price has risen. If I zoom out a bit, has risen since early in 2024. As I said, prices are up about 80%. And then if we zoom in to the nearer term picture, although there is continued potential for the price to rise during 2025, in the near term, yeah, we might very well get a bit of a pullback. It's fallen back there a bit there today. This dashed orange line about £1.10 per therm is the initial downside target. So the price may very well come down to near that. If it were to fall through that level, then we'll be talking about downside level somewhere around 98p. But the initial target, downside target, is about 110 pence per therm. And then on the upside, if and when the price begins to push higher, then once it takes out 120, this dashed purple line, then that would suggest a continued upside. Okay, so that's where we are, folks. If you have any questions on the market or on risk management, then please feel free to drop me a line. All right, thank you.